So last week, we have completed the investment decision, and we also completed the present value analysis, I think. And I give you the yes, I give you the present value analysis using Excel.
Yes, as well.
Yes. So I think that's where we stop. We basically were we were showing the analysis using the net present value, but I want to just simplify this analysis so that we can use it to complete the evaluation. I want to now give you this notes on the on the capital investment decision. Right. So I hope you can see my spreadsheet now. I have designed in such a way that I will start with the assumption, and the first assumption is the initial investment, and we assume here that the investment will come in several years. Later on, we can change to see if it has a different effect on the project. In this case, we say that the investment will come in 5 years from year 0 to year 4. And that is in million. And then we have the annual maintenance and upkeep costs of 500,000 per annum. Then here is the revenue stream per annum for 5 years. This project is a 5 years project. So this is the annual revenue stream. And then we have the cost of capital. And we say that the cost of capital is, say, 10%. Yeah, at 10%. And then we will actually put this in this format, and this is the final projection format. So the final projection format up to the present value. What we did is just copy from the assumption here. For example, cash flow, cash inflow from revenue here is copied from here, the revenue, and then we just copy through. Sorry. This is from here, and this is from here, and from here, from there, right? I need to erase this. So here is the total for 5 years. So we just take the sum as the revenue. Then we have the capital outlay. Also, we do the same. We just take this 2 million from top there and the rest. Okay. Then also the maintenance. Maintenance begin in year 1. So we take the maintenance also from here. And we do the same for the rest. So we get total cash inflow and total cash outflow. So this is total cash inflow and so this is total cash outflow. Okay. Then we compare the total cash inflow with the total cash outflow. Essentially, we just take the figure here minus the figure of total cash outflow, and we this is not right. This is supposed to be total cash inflow. No, 0. So the net cash inflow is total cash inflow minus total cash outflow. Okay, so we got the we do the same. We just copy through, and now we will calculate the discount factor. Discount factor for year 0 is 1. Don't have to calculate, just put 1. And discount factor for year 1 is if you recall, we use the formula 1 1 and we divide 1 with we divide 1 with um, the 1 plus
Dibuat ni kan dalam supplement. Ya.
plus R to the we will use the small r to represent the cost of capital. Okay. So, and for year 1, here is 1 divided by 1 plus 1 plus uh, instead of writing R here, we drag the cursor to uh, R here, cost of capital. Yeah, so it is. Then it will capture the 10%. The same thing for year 2. We will take 1 divide by 1 plus drag again to that 10% plus 1 plus drag again to that 10%. And so we will have the formula to capture the 10% rate. Why we are doing this is because once we did this, we can actually alter the rate here and will immediately be reflected in the calculation without us having to go through it again one by one. So that's the advantage. So this is especially important later on when we want to calculate the IRR. So the uh, we got the interest rate. Oh, sorry, the discount rate for year 1, year 2, year 3, year 4, and year 5. So we can extend this to 10 years if you like, but you have to go recalculate for year 6 to year 10. Yeah. Okay. Then we now calculate the present value. So we take the net present value just now and multiply down by the discount rate, and we get the present value. So this is the present value after discounting. We saw here that the amount has been decreased by the discounting rate. Okay. Now, if we take the total here in years total, we see actually we have the net present value. Yeah, net present value actually. But we will calculate the net present value also separately by taking the present value of revenue, where we discount the revenue separately. So this is the revenue that will be discount at the same rate just now, and when we discount, we get the present value of revenue every year for the 5 years. We also discount the maintenance cost, of 500,000, discount by the same rate, and we get the amount of discounted. Then we minus the present value of revenue minus the present value of maintenance. We get the present value of operational cash inflow. So this is the net present value, and this is the total for 5 years, 26,000. Then we now take the present value also of the capital investment or the outlay, the capital outlay here. For year 1, for year 0, we don't have to discount because it's the discount rate is 1. For year 1 is 3,000 multiplied by 0.909. So we get here the present value. So this is a unique thing, because when you incur your capital outlay in the future, uh, even though you incur 3 million in year 1, actually based on today's value, you are only paying 2.7 million. The same thing in year 2, you invest, you need to pay 7 million investment, but actually in terms of present value is only 5.7 million. In year 3, 8 million. You discount at the rate of 0.75, you actually invest 6 million. And year 4, you invest 6 million, but discounted at 0.68, you only invest 4 million. There's no investment in year 5. So when you total the investment, you have to include the 2 million. So the 5 years that you invest, your cost is 20 million. So the net present value is the difference between the present value of operational cash inflow and the present value of the outlay. So it's 5.8 million. So in this case, you will conclude that the project is viable because the net present value is in excess of present value at 5.8 million. This is actually a very good project at 10%, but maybe 10% is too low. So even if you discount at a higher rate, for example, at 20% here, you just change the 20% and everything will be reflected at 20%. You see that the project is still viable, is still giving 3.6 million return. Okay, so
Should we calculate also the present value index?
We will come to present value index shortly.
Okay, thank you.
Right. Okay, now after we have done the net present value analysis, we go into the other methods of evaluation of this project, and we will start with the conventional method of accounting rate of return. This is the accounting rate of return. Accounting rate of return is the net profit after tax divide the average investment. So what we will need to do is to calculate the profit after tax, because we need a figure of profit after tax. So we take revenue, use the figure revenue there. We just copy back here from the revenue figure up there, 6 million, and then maintenance costs we also copy up there, and then just copy through. So when you copy through, you just copy there, and it will be captured. The same thing with the 500, and then you take the difference between revenue minus maintenance costs become profit before tax. So you just basically take 6,000 minus 500, and then you copy through, and then you will now work on the taxation at 24%. 24% taxation is you just take 5,500 multiply by 0.24 and copy through also. Then you have the profit after tax as the profit before tax minus taxation. Then you calculate the average investment, and average investment here is a bit tricky because the investment is done in installment. 2 million in year 0, 3 million in year 1. So you need to average between the 2 million and 3 million in year 2, and take into account 7 million in year 3, and so on. So you have the average investment. This is to calculate the accounting rate of return. Yeah. So you get your accounting rate of return calculated here as net profit after tax divided by average investment. 152% in year one, 82% year two, 57% year three, percent year four, 44% year five. So it is high but declining as because the investment has become larger as it goes by. Okay, so that's your first calculation, the accounting rate of return. Next, we going to payback period, and payback period is normally used when you have one a year of uh, or the initial investment is in year zero. If all the initial investment is in year zero, then it is easier to calculate the payback period because uh, you are just working on how to recover this investment in the future year. But in our case here, because the investment also occur in year two, three, and four, so we need to take into account the investment every year and calculate the what we will calculate is the accumulated cash flow balance, and the accumulated cash flow balance every year, taking into account the 2 million in year zero, will give you actually the payback period. And so, for example, the for year zero, of course, it's uh, negative 2 million. But in year one, if we look at the net cash inflow, in year one, the net cash inflow is 2.5 million. So the accumulated cash is actually 2.5 million. Actually, is this is 2.5 million net cash inflow plus um, 2 million negative. So it is 500 in year one, and in year two, it is um, net cash inflow uh, net cash inflow uh, plus so it's zero. In three, year three is net cash inflow so it's negative. In year four, uh, net cash inflow What's happening? So, net cash inflow. Nice. Uh, I wonder what is happening. Let me try again once more. Uh, Then and India 5. Plus. So you'll see that the payback period is actually in year one you have a positive cash inflow, which means that the payback period for the first part is year one. Then in year two is zero. Also, the payback period is achieved. But in year three, you have a negative uh, uh, accumulated cash flow. So actually, you are back on the negative payback period. But in year four and year five, you are positive. So we can say that the payback period of this project is about 3 years. Yeah? 3 years. Or actually, you achieve payback in year four. Right. Now, next, we will.
Sir, the payback
Yes.
period, we don't need to like factor in the what the discount.
No. You don't discount.
Okay.
Yeah, you don't discount. You just take the nominal figure.
Okay. Okay.
Next is the net present value. In the net present value analysis, we have calculated just now. So we just use the figure and we just conclude that since the net present value is positive of so it is 3666,470. So in excess is in excess of the investment. The 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 project is giving 3.6 million in excess um, excess return over the required rate of return of 10%. So we say that the project is viable. Okay, now we go into profitability index. The profitability index is calculated as the present value of cash inflow divided by the total cash outflow. And this is the present value of cash inflow. We take from here the present value of cash inflow 20 million and the present value of capital outlay here is million. And so we 6 million, yeah. The, so it is actually the profitability index is um, 1.22. 1.22, when the profitability index is higher than 1, it means that the project is viable. The project is viable. So it is in this case it is 1.22. So it is 22% higher than the investment. So it is a very viable project. Okay. Finally, this is the most uh, um, cumbersome. It is the internal rate of return. We say that internal rate of return is the actual rate of return of the project, and the 10% that we are using here is just like a cost of capital that we guesstimate. We guesstimate because that is our cost. So we use 20%. We use 20% here. So yeah, I must have written wrongly somewhere. Yeah, it should be 20% because the project is giving a return of over 20%. So in this case, the internal rate of return will be calculated, and to determine the IRR, we will find the suitable rate where we achieve a zero net present value. So we will iterate. This is the process of iteration. We will iterate the rate. That means we will keep changing the rate here in the cost of capital in our assumption, and we will keep on changing this one until we get the net present value of zero. And the net present value is this one, yeah. Right now is 3.66 million. When the net present value is positive 3.66 million, it means that the discount or the IRR must be much higher than the existing rate of 20%. So we will need to change that 20% to a higher rate so that ultimately we will have the net present value equals to zero. So we will now change the rate here. Let's say we change to 40%. When we change to 40%, our IRR is still positive 1.393 million. So that means that the IRR is much higher than that. Let's try 50%. At 50%, the IRR is still positive 777 million. So we will know we know now that the IRR is higher than 50%. Let's try 60%. At 60%, it's still positive 341,000. So we know that it is higher than 60%. Let's try 66%. At 66%, it is still positive, 139,000. So we change again, 68%. At 68%, it is 79,000. Still positive, but a smaller figure. Now we will say 70%. 70% is still positive, 23,000. So it is higher than 70%. Let's try 73%. Now it is negative. So we know that it is lower than 75%, but it is higher than 70%. So let's change to 72%. At 72%, it is still negative. That means it is at 70 point something percent. 71.5%. So it is still negative. 71.5 is still negative, so it is lower than that. So it is 71.45. It's still negative, so it is lower than that. 71.43. Still negative, so it is lower than that. So 71.42. Still negative. 1.42 still negative. So it's maybe 71.41. Still negative. What about 71.4? Still negative. Why is it not changing?
Bro, 71.3, bro.
71.3, yeah? 71.3.
It's lower than 71, sir.
Is it?
Yes, I
Now,
think.
now is 11. 11% is so lower than 71, you say? So let's put at
70.8.
70.8, yeah?
Dari tak 7 malam begini tau.
Perhaps we can use a goal seek function
Bila saya dah perangai ni.
in the Excel.
70.8. Yes, 70.8, there is still left 1.68. So we know that it is higher than that. Higher than that. So maybe it's 70.81. 70.81, 1.42. So it is higher, 71.42. 2. Uh, 1.15. Okay. We need to reduce a bit, or rather increase because it is still positive. No, it's positive, so we need to increase. We need to increase to 71.83. I thought it would look, all right, 0.88. So it is slightly lower. Slightly lower. So it is 825.
Shouldn't it go higher?
825 is where we it's 1.01. 1.01. So it is now it is positive. Yeah, 1.01. So we need to increase. We need to increase. Maybe 7. Yeah, 0.96. Almost 0.96. So we need to get so it is still positive. So we need to go higher. 91. We need to go higher. So maybe is 3. 70.83. 88. We need to get it higher. Yes, 75. Higher. Okay. This iteration process is rather time consuming, but this is the only way. But if you use your financial calculator, they will calculate you exactly immediately. Yeah. Jangan. It's 0.61, so it is higher. 0.86. Right. 0.08. Just a little bit more. To 2. Yes, just one more point. This is right. Okay, we got it exactly now. Is 0. So what is the IRR? Is 70.873. So this is the actual rate of return of the project. You see how we get such a big return is because our cash outflow is in installment, and when you have cash outflow in the future, you see the outlay, just the cash outflow. Even though you are, for example, you are spending 3 million, but actually in terms of outlay, because it's been discounted, is only 1.7 million. The same thing here. You invested 7.5 million in year 3, but actually, sorry, you 7 million in year 3 is actually only 2.3 million in the present value. Here, 8 million in year 3 is only 1.6 million, and 6 million in year 4 is only 700,000. So this is what is the implication of this is that actually, if we can defer our investment in the future, we will make some return in the form of the net present value. All right. I will pass this to you, and this is the complete discussion about the capital investment decision. I also have sent to you, or rather upload to you the capital investment slide for you to go through. And right, where is that? Now it's the where is that? Here, okay, this is capital investment decision. By the way, do you all have lecture after this?
We have a 2:30, bro.
Yes,
Yes,
Prof.
yes, we have.
2:30.
Yeah.
We have
Uh,
lecture after this.
Actually, I need to take a break for a while because I am actually in the car, and I have reached my destination, but I need to find source of plug to charge my laptop and so on. So I need to organize. If I will try to settle within 20 minutes or 30 minutes, and after that I will open back. For right now, my battery is almost exhausted. So what we want to do after this is to discuss on another topic. And if we look at the module, we have discussed time value of money. We now want to go into stock valuation and bond valuation. So that we will cover after this break. Okay. Sorry, a bit late. Let's continue. We want to start a discussion on the stock valuation. Actually, we have discussed this also indirectly.
Sir,
Yes.
just want to double check just now. Do you mind to open back the Excel, the capital investment decision?
All right. Okay.
Just want to
Okay.
double check the average investment, that part.
All right. What's that? Is it this one? No. Yeah. Okay.
You need to share screen.
Oh, okay, okay.
Yep.
Um, uh, all right.
Okay.
Mm-hmm. Okay.
The other one, Prof.
For the part for the average investment
This is the accounting rate of return.
yes, scroll down until the here average investment, sir. This
Yeah.
at the row of 90.
Okay.
The 2000 2000 2750 for the first year, then 6000 for the second year. The formula there is it we should divide, we should using hash, we should using the column, the row of 47 instead of 51.
Well, basically, what I did was I just used the average investment in year one,
Okay.
which is take the total investment in year one. Yeah, total outlay is 3
The
million.
outlay lah.
Plus the second year from the year zero, and
Okay.
then divide by 2.
Okay. And then by the following year, do we need to divide by 3, 4, 5, or still divide by
No,
2?
still divide by 2 because it is an average investment, so it'll always divide by 2.
Oh, okay.
So it's like this. And then for year 2, we just take investment in year 2, capital outlay in year 2, plus capital outlay in year 1, plus capital outlay in year 0, and divide by 2.
Okay.
So, yeah. Right. So, year 4, year 3 actually. Year 3 is capital outlay in year 3 plus capital outlay in year 2 plus capital outlay in year 1 plus capital outlay in year 0 divide by 2. Right, yes. And capital outlay in year 4 plus capital outlay in year 3 in year 2 in year 1. Right. So for year 5, we use the same the average for year 4.
Okay, noted.
Okay, noted, huh?
Thanks.
Right.
Bro, why there's no capital outlay in year 5, bro?
Because this investment is only there's investment in 4 years. I mean, this is you can imagine this as an investment in a certain project. Let's say building a ship. Yeah. So you imagine that this is Boston building the submarine. So they only incur expenses for the first 4 years, and then year 5 is just finishing job. So no capital outlay. Right?
Okay, no, thank you, bro.
So what is the purpose of using this average investment for? Because I do not understand as well why is it divided by 2.
Because it's average divided by 2 means we take the opening and ending divide by 2. So it is
Yeah, what is this? What is this? The purpose of the calculation of the average investment for?
just to calculate the ARR, the accounting rate of return. The accounting rate of return is net profit after tax divided by average investment. So now here we see the rate of the rate of return, the accounting rate of return. This is not refined, and that is why we normally are not using it conclusively. We will calculate, but we will always in the end compare with the net present value and the internal rate of return. Internal rate of return is the ultimate return. That is what matters in the calculation. All right.
Internet rate of
And then
return is net
for the
present
average
value, isn't it?
return,
The internal rate of return is the IRR that we calculate just now. Finally, using the discounted cash flow, we want to know what is the real internal rate of return, and we reiterate to find the discount rate that will generate 0 net present value, and at 0 net present value, that is the actual return.
So it means the cost of capital's interest rate also very high.
Why?
I a bit confused of the cost of capitals. Why is from 10% can increase up to 70%? Does it means that the interest
Okay.
rate also become very high?
The 10%, was our own estimate, our own cost of capital. But maybe we said that 10% is too low, so we change that to 20%. Even at 20%, we started with 20%. We say even at 20%, the net present value was still very high, right? But we want to know what is the actual internal rate of return. So the internal rate of return is the actual return on the project. So how do we determine that? We will find, because for example here just now at 20%, at 20% our net present value was 3.36 million. That means the project is still giving 3.6 million per annum. 3.6 million overall, over and above the 20% return. So the internal rate of return is much higher than that. So we want to know what is the internal rate of return. So we will reiterate and change that cost of capital. We will change that until we get a zero net present value. And at zero net present value is the discount rate that is used to get zero net present value is the internal rate of return. So it is the actual return of the project. 70.863%. This is the actual rate of return.
Okay, so it means that actually the interest rate should not more than 20% if to get a positive net of NPV. Can I say that?
Well, at 20%, our NPV was still positive 3.36 million. So it is we can afford to have a higher cost of capital. But I mean, cost of capital is what we expect to get. But the actual rate of return of the project is 70%, 70.863.
Understood. Thank you.
All right.
So
Thank
in
you.
overall, when we see this 70%, it means this is a very, very good project.
Very good project, yeah. But like I told you,
So,
why
sir,
it is such a good project is because we can delay the capital outlay. We can delay our investment. Just like building that submarine lah. We invest in installment, and so even though we, for example, pay 8 million, 9 million in the fourth year, but actually based on the present value, the amount is only 700,000 because of the high cost of capital. Right.
so
But
the
it's
average investment just now that you calculated, isn't it we take from the capital outlay instead of our net total cash outflow
Which
for the
one?
average investment? For the
Which
average
one?
investment that Simon asked just now,
Yeah. That
average
is only
investment that
for
Simon asked just now,
the average investment. There is only for purposes of calculating accounting rate of return. But actually,
yeah,
based
because
on
I
the
see in your formula, sometimes you take the total cash outflow instead of capital outlay to do the to calculate the average investment.
no, just now I
The
took
first two calculations you took, the first two
I
calculations you took
think
total.
Prof already changed to the 47 already. He using the investment
Oh,
already. Amended just now.
okay.
yeah.
Yeah.
Okay, thank you.
Right. Now okay, let's move to a new topic. And here is on stock valuation or share valuation. Essentially, we want to now discuss how do we value share if we invest in share, or how do we value our own share. So as an introduction, share valuation is essential concept for business professional and investor. The method is used to determine the value of a given share in the market. The identified intrinsic value in this case indicate a distinction with the current price. Financial manager are always concerned with the issue of understanding the concept of time and how loan can be borrowed and repaid within the estimated period. And so they ensure that the borrowed fund create a significant impact in the business. And we will cover the fundamental concept of share valuation, such as the time value of money, the capital asset pricing model, the dividend discount model, and the price earning ratio model. First, we look at inflation and time value of money. We discussed this just a revision here. Time value of money is an essential tool used in to understand the worth of money concerning time. So time value of money formula is used by investor to understand value of money and how it compares to its importance to the future. Inflation does increase the price of good and service, and it also means that it's reduced the number of goods and services that one can purchase with a dollar in the future. Unlike today, when the wage remain the same, inflation increase the price of goods and services, and it take a larger percentage of percent income to buy the same good. So inflation occur because of the rising price. Factor of demand and supply also drive inflation. The rising demand increase the costs, while the reduced supply also increase the price. Demand increases since consumer have a lot more disposable income. When there is more spending, inflation increase. Inflation rises when there are rising or steady wages, and when there are low unemployment level. Low supply will reduce demand and make the price higher. So the market is working to create an equilibrium, and in the process, it will normally increase the price if there is lack of supply or there is increase in demand. There are vital risks to investor, and asset may increase in value or may depreciate in value. That risk needs to be taken into account also in business. So the main principle in the time value of money is that money is worth a lot more today than in the future, because money someone has the potential to earn, and this is large because of inflation. Through investment, there is a specific risk that someone must consider as they use time value of money. So time value of money is crucial since it helps investors to make informed decisions. Time value of money is vital because it has the basis to understand money based on inflation. Time value of money assume that a person does not invest the available money in an equity security, interest-bearing account, or debt instrument. So here is an example where 1100 invested for 1 year at 10% will become when we multiply 1100 by 1.1, it become 1 to 1, 1 to 10. But because inflation is at 10%, so the amount when they're discounted using a discount rate of 0.909, will actually reduce back the amount of the 10% return into the 1100. Now, dividend discount model, DDM, is defined as the quantitative technique that is used in the company stock to predict the price. Dividend discount model therefore hold the worth of an investment which is equivalent to the total value of the net present worth of all the anticipated impending dividend. It appears in many classes due to diverse statement concerning the anticipated growth in dividend. To calculate the fair value of share using the Gordon growth model formula, which is the simplest form of a dividend discount model, we identify first and then use the simplified formula. So this is the price of share. The price of share is determined by the dividend, future value of dividend divided by R minus G. R is the rate of return, which is the interest rate or the cost of capital, and G is the growth rate or the stable rate of growth of dividend. So in circumstances where there is no growth information, constant growth is assumed. And this formula may not be accurate, but can be used to show the value of stock based on the dividend. And dividend discount model has several restrictions, and it needs a lot of estimation about the future of the company. Therefore, to use this model effectively, we must educate we must make educated as presumption on the company dividend payment patterns, the patterns of growth, and the future interest rate. So, well, everything is about estimate and guesstimate. The model will not work if the company does not pay out dividend. Nevertheless, it is a very important tool since it's really assured investors to critically think about the potential outcome and re-examine the assumption. So, advantage of the dividend discount model is that it is very convenient during the process of valuation, where valuations of dividend as a process in this model does not need growing convention or for value creation. So we just make a guesstimate on the dividend growth rate. Based on the past growth, we determine what is the cost of capital and what is the last year dividend. The disadvantage, of course, is that it is excessively basic, and this model can only work best where the companies provide the growth of dividend consistently each year. It also enables us to increase the value of our portfolio. Attainability of investment is easier when we use the dividend discount model. But the non-dividend factors are not included. The share valuation is influenced by many factors, such as the brand loyalty, retention of customers, and ownership of intangible asset. For example, today, the ownership of patent, right, copyright, brand name, trademark is very important. It operates inside a boundary of safety. A boundary of safety is part of the dividend discount model, and therefore make it safer as compared to the other model. But it is against the taxation rule. In many countries, dispersing dividend is not valuable from a tax system, and therefore, to some extent, it is profitable to sell share repurchase and repurchase. Yeah. Okay.
Adik.
Price earning ratio. Um. I need to. Right. This is um the next method is the price earning ratio, and we discussed this quite extensively. It is a method used by companies to determine the price of their share if they are listed on the stock market. The ratio is calculated by dividing the market value of a single share by its earning. According to this computation, high price earning ratio will imply that the share of a given company are overvalued. So if we can calculate a price earning ratio by taking the share price divided by the earning per share. So we can, and normally earning per share is shown in the company's income statement at the bottom of the income statement. They will show the earning per share, and so if you get the share price based on the last traded price divided by the earning per share, you will get the price earning ratio, and then you will compare this price earning ratio with the price in the industry or in the same industry, the average price in the industry or the average price in the stock market, and you will know whether it is too high or too low, or it is the right price. And based on that, you will then make a decision whether this company is overvalued or undervalued. If it is undervalued, then it is timely for us to pick up or to buy. So essentially, price earning ratio give an expectation of the investors of the company's future performance. Forward price to earning. The forward price to earning uses projected earning, projected future earning to calculate the price earning ratio. And the trailing price earning, which is the standard form of the price earning ratio, is calculated using the recent past earning or the recent net profit after tax. It can be helpful for investor to consider both calculation, the price earning ratio. If an investor has noted the forward price earning ratio from the previous year, then the investor can check to see how accurate is the previous year estimated price earning based on the current price earning. The forward price earning calculations are um, hmm, Okay. The the forward price earning uses projected future earning to calculate the price earning ratio. The trailing price earning, which is the standard form of price earning ratio, is calculated using the past or the recent past profit. It can be helpful to investor to consider both calculation of price earning ratio. When analysts refer to price earning ratio, they usually refer to the trailing price earning ratio. It is calculated by dividing the current market value or share price by the earning per share over the previous 12 months. So this measure is considered the more reliable of the two metrics, since it is calculated based on the actual performance rather than expected future performance. However, it could prove a limited or faulty estimate since the company performance factor, costs, and profit change over the time. But the trailing price earning has its shares of shortcoming, namely the company past performance do not signal future behavior. So the fact that earning per share numbers remain constant while the share price fluctuate. Forward price
Okay.
earning, yes.
Can I know where can I get the trailing PE ratio in, let's say, the KLCE, or where can I read that one?
You can calculate. You can calculate the trailing price earning. Essentially, the the trailing price earning ratio is just taking the current price divide by the earning per share of the last year.
Of the last year, on should I see on the months also?
No. Normally the every company will submit a quarterly account, and quarterly account means they submit every 3 months. So we will normally have the annual account of last year, and that is supplemented with the past 3 months. And if you look at the past 3-month account, you will see they also do a 12 months uh, 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 figures from the last. So for example, let's go to Bursa Malaysia, and so if we take a company, for example, we take a company, let's say
Red Hill.
my DI IY. Why is it not there?
MR.
MR, yeah, Mr. DIY.
Yeah, right.
Is that? Uh, uh, doesn't
No
appear.
space.
No space, huh?
Yeah, no space.
Also doesn't appear. That's Mr. Yes. Why DIY? Because they were recently listed, and the company make a big impact in the market, and you see the share price went up, and actually for last 2 years, so we will go to the company announcement, and the company announcement we will search for quarterly report. So normally they will show the quarterly statement. Yeah, the last quarter was 31st March. So, and so here is the quarterly statement of DIY. Here you have individual quarter, 31st March 2024 and 31st March 2023. This is a comparison per quarter, and this one is cumulative quarter. Cumulative quarter is including the last quarter. So you can convert this into an annual figure. There is a earning per share here, earning per share, and you can use this earning per share as the basis. For example, we look at the share price. The share price was the share price was closed at 186 and 186, and here the quarterly earning per share is 1.36. 1.36. We can assume we can annualize this. This figure is quarterly 2024. You multiply that by 4, you will get the estimated annual, and then you divide that share price by this, and you will get the price earning ratio. So for example here, 1.53 multiplied by 4 is about 6, and the price is 160. 186. So 186 divided by 6. Actually, it's not 6. It's 0.1. This is in cent. So 1.53 multiplied by 4 is 7.2. Is it 7.2? 7.2 is in cent, so it is 0.
4, is it?
6.12.
6.12.
6.12.
Yeah, 6.12 is 0.06 12. So now you divide 186 by 0.612. You will get the price earning ratio.
3.03.
Why is 0.612, sir?
Why? Because 6.2 is in cent. So we want to convert that into ringgit, because your price is in ringgit.
Sir, in our case, this earning per share is net present value, isn't it?
No, earning per share is not in net present value. This is in conventional nominal price.
So
So
one
here
point 1.86 divided by 0.612. Am I right?
1.86 divided by 0.6,
12.
0.06
0.0.
divided by
Oh, cent.
0.0612. How much is that?
30.39.
Yeah,
30.39.
30.39. So the price earning ratio is 30.39, 30 times, yeah? 30 times, 30.39. So that's the price earning ratio. And then you can compare this with other company in the same industry. We can compare with other retail company. Well, actually, 7-Eleven has a price earning ratio of 40. But if you calculate, for example, another IOI, no, Eon has a price earning ratio of about 35, like that. So 30 is quite reasonable, is even though it is slightly high, slightly high. Right. Now, forward price earning. The forward price earning is is calculated by using projected future earning to calculate the price earning ratio, and the trailing price earning, which is standard form of price earning ratio, is calculated using the recent past earning. So when we use recent past earning, it is actually the trailing price earning. Now, forward price earning ratio estimate the company's likely earning per share for the next 12 months. So the forward price earning is favored by analysts. So how do we use forward price earning? We estimate what will be the profit for the next year. We can make some assumption that the performance will continue, for example. So forward pricing relies on estimated future earning. It is subject to miscalculation and bias, but that's the best we can do. Trailing price to earning. Trailing price to earning is a relative valuation multiple that is based on the last 12 months actual earning. It is calculated by taking the current stock price and divide that by the trailing earning per share. So trailing price earning can be contrasted with the forward price earning, which instead use projected future earning to calculate the price earning ratio. So earning for the most recent fiscal year can be found on the income statement in the annual report. At the bottom of the income statement is the total earning per share, as we saw just now. So trailing price earning ratio is current price earning divided by trailing 12-month earning per share. The measure is considered the most reliable because it's calculated based on the actual performance rather than expected future performance. Why price earning? Analysis like the price earning ratio. Analysts like price earning ratio because it's create an apples to apples evaluation of relative earning. The price earning ratio can be used to look for the relative bargain in the market or to determine when a stock is too expensive compared to others. Some companies deserve a higher price earning multiple because they have deeper economic moats. But some companies with high share price relative to earning are simply overpriced. So likewise, some firms deserve a lower price earning because they represent a great bargain, while others companies are justified in a lower price earning due to the financial weakness. So the disadvantage of the price earning ratio is the stock price are constantly moving while earning remain fixed. So analysts attempt to deal with this issue by using the trailing price earning ratio, which use earning from most recent 4 quarters rather than earning from the end of the year. So by using the quarterly report, we will overcome this. Example, a company with a stock price of 50 ringgit and 12 months trailing EPS of 2 ringgit. Those has a trailing price earning ratio of 25 times. And this means that the company stock is trading at 25 times its trailing 12 months earning. Using same example, if the company stock price fell to $40 midway through the year, then the new price earning ratio is 20 times, which means the stock price is now trading at only 20 times. Earning for the last 2 quarters may have dropped, and in the case, analysts can substitute the first 2 quarters of the fiscal year calculation with most recent 2 quarters for the trailing price earning ratio. So if earning in the first half of the year represented by the most recent 2 quarters are trending lower, then the price earning ratio will be higher by 20 times. This will tell analysts that the stock may actually be overvalued. Okay, constant growth model, CGM. The constant growth model is described as the differences of the surplus discount model, which is used as the procedure of pricing any corporation. So the constant growth rate of future dividend is usually determined by using a simple model of constant growth model, which is the Gordon growth model. The Gordon growth model is common and upfront optional for the dividend discount model. It is adopted by Gordon growth model proponents that there is an endlessness growth of dividend which occurs at a constant rate, and therefore this solves the current worth of the unlimited sequence of the coming bonus. Due to the adoptions of the continuous growing amount, since the model adopt the continuous growth rate corporation that have constant growth rate concerning dividend for each share. So the constant growth model on that note is simplified using this formula. This is the formula. Price of current share is equals to the dividend value for next year divide by R, which is the return rate for the company, the cost of capital, and divided and less the growth rate of the dividend. So the growth, the Gordon growth model values cooperation in investment from the ideas of endless progress in shares. So using this essential rate of return, the model will discount back the investment due to the assumption of uh, the endless in sequence of the dividend per price per share. So there will be a constant growth rate that will increase per share due to the assumption that cooperation will forever exist to pay for the required dividend. However, the idea that there will be a continuity in the growth of the dividend per share will make this model disadvantage. So when buying any company's share, the main the main concern to the investor is always the dividend per share of a company growth rate from one year to another. However, it is with much concern that the common fairness to shareholders is signified by the yearly expand cooperation. So these are the advantage and disadvantage of the constant growth model. Okay. Next, we go to the capital asset pricing model. Capital asset pricing model, or CAPM, is the model that label the affiliation amongst the methodological risks and the likely return of investment. CAPM has extensively used, extensively used all over the world, and it is using the asset in valuing the safeness, the safetiness of the existing investment, and it is using this formula. The expected return of investment is equals to the risk-free rate, RF, plus the beta value, which is the beta value of the share, and multiply that by the premium of the risk market. This is quite difficult to use unless we have the market data on beta and so on. The risk-free within the formulation explain the value that money has concerning time. The possible asset is a measure of how much risk investment will appreciate. So beta is increased by the premium risk in the market, and this is the risk-free rate, which the investors anticipate from the market. Predictable outcome of the formula can be used to deduct the likely bonuses in addition to the investment increments of these asset within the anticipated period. Another model that is also useful is the variable growth model, and this is also called the dividend growth model, and it is a dividend valuation approach devised by expert to navigate the numerous investment option that present to allow a change in the growth rate of dividend. It helps the selections of individual equities, which are the best fit for the specific strategies of their portfolio. Estimating the fair value of equity is the particular purpose of the variable growth model. Okay. The comparison will help to determine whether specific equity is underestimated or overestimated. This is an example of how the calculation and the comparison is done. Okay. Generally, the minimum rate of return that an investors require for the risk level associated with a specific investment in the is the measure of the return rate, and beside the capital cost of the weighted average is equivalent to the required rate of return for the equity valuation. So in summary, the value of money changes with the time, and common factors will include inflation. Managers use the dividend discount model to predict the price of the share for the future date, and the capital asset pricing model will focus on the risk that is existing when the evaluating the assets. Right. Any comment or question? This is a bit technical, especially on the capital asset pricing model and the dividend growth model. But normally, the use of earning per share is sufficient. It's sufficient to for us to estimate the future price. Comment or question?
Talking about this stock valuation and also the growth formula, I know that we have our assignments and all that, right? So should we imply a few or we choose one?
Come again on that.
Because based on this, right? Because we have assignment also, then the assignment is also that because this is the formulas and the things that we have to imply as well together in our assignment. Should we select a few theory methods or we should imply a variation of it?
You should attempt each of it. and then
Mm-hmm.
you compare the
Oh,
result.
which one is the best? Okay.
Yeah, right.
Okay, understand.
Okay, you want to ask about assignment? Anyone?
Prof, and also from
Yes, sir.
that,
Can you
I know that you are a busy man. Would you be able to do one extra just for the assignment? Maybe 1 hour just extra for that
Okay, no
in any
problem.
day,
Yeah, we
like
will do
maybe
that.
maybe at night, or maybe on the weekdays nights, or maybe on Saturday, if let's say it's suitable to your schedule.
Okay, we will try and do it next week, Saturday. I have class Saturday 9 to 11. I can do after that.
Sounds good, Prof.
Anyone else?
Prof, sorry, Prof. It's me, Syed.
Okay.
Regarding the assignments, Prof, you expecting how many word counts and how many reference and citation?
No need. No need to be very specific about that. I mean, just I mean, especially the group assignment. Group assignment, you do it in group, so you divide the work and divide the write up, and individual creativity will prevail. No limit and no specific requirement.
Okay, sure. Thanks, Prof.
All right.
Okay, Prof, we are waiting for the extra class.
Yes.
Thank you for suggestion. Thank you.
All right. Okay. So next week, I will post in WhatsApp. We will meet at about 11:15.
Can, Prof, can.
All right.
If let's say you want to do in Google Meet also, it's possible.
Yeah,
Because
Google Meet.
this one is under SKC, right?
Okay. Yes. Okay. All the best.
Thank you very much, Prof.
Right.
Thank you, Prof.
Thank you, Prof.
Prof.
Thank
you, Prof.
Thank you, Prof.
Thank you, Prof.
Thank you,
Thank you, Prof.
Salam.
Prof.
Thank you, Prof.
All right.
Thank you, Prof.
Thank you,
Thank you,
Prof.
Prof.
Ada lagi lebih 23 minutes. 23% lagi.
Prof, are you still there, Prof?
Pardon?
Are you still there? Okay. Just a quick one, Prof. Sebelum kita, I just nak tanya pasal this group assignment.
Right.
So pasal this solar power plant kan?
Right.
Okay. Kita pakai this data yang given tu, we need to find a new set of data.
You can use the data given, but
Okay.
the data given mungkin kalau if you have some recent data more accurate, you can use your data. What is important is you specify your assumption on top.
Understood. So we can use this data yang bagilah, tak payah nak buat research sendiri ke apa, no need lah.
Betul.
Okay, baik. Thank you, Doc.
Yeah.
Right.
So I think we need to research on the requirement electricity consumption for the Sungai Petani industrial park, right?
Right, that's right. Yes.
Yeah, there is further data that we need to research, right? Not just based on the feasibility report. The feasibility report is not related to the question that you asked for specifically for the Sungai Petani industrial park at all, right?
That's right. Yes.
There was just a general data. Am I right?
Right, that's right.
Thank you, sir.
Right.
So for the individual assignments, can I ask a question? I understand that you're going to explain further on the coming Saturday. But for the individual assignment, the second one is pertaining the retirement funds. We calculate on the capital. So we just make the assumptions that we are not going to make the withdrawal on the money basis. We can make it assumptions, whatever assumption factor or parameter we just put there, right? Instead of like monthly withdrawal, we can put it like yearly withdrawal, right?
That's right. Yes.
Yeah, and the second question pertaining that we need to create a business, selecting a product or either the good or services. Then eventually we'll bring this company to fulfill the corporate listing requirement in Malaysia, right?
That's right. That's right.
Thank you, sir.
Okay.
Hi, Prof. Sorry, just a quick one. For this subject, right? How many assignments that we are going to do, and also do we have like a midterm exam or final exam? I mean, final assessment.
There is no final exam. There's only one more assignment, which is the take-home exam. And
Okay.
the take-home exam will be given one day before, and you
Okay.
will have 24 hours to attempt it. This is individual, not group.
Okay. So basically, we have 3 in total.
Yeah. Yeah.
3 assignments. Okay. All right. Understood. Thank you very much, Prof. Have a good weekend. Goodbye.
Okay. Bye.
So again, it's me.
Yeah.
So on the individual assignment question 2, since this person not able to save money for 30 years up to 2 million for retirement fund, and then we are required to develop a business to get this business listed within 5 to 10 years. I believe this person, we need to assume he has no capital, and then we need to do the angel funding, crowdfunding, then eventually to be listed in 5 to 10 years, right?
Well, this is why you need to plan well, like we discussed in the class. You can start as small as possible with one stall, then you grow. If you add one stall every month, in 1 year you have 12 stall, and then after 12 stall, then you can incorporate into a company. You will inject that into your company, then you will grow, and that is the time when you actually grow the business and make it as prepare ready as possible for listing.
Understood. Thank you. So we can do angel funding, crowdfunding,
Yeah,
that
you
model
can.
in order
You
to
want. Yes,
for
you can. Yes.
the stores they're going to do every month, right? If not, there is impossible for a person that not able to save 1,900 ringgit per month and eventually can bring the business to be listed in 5 years, right?
Well,
There must be
this is the magic of finance.
yes, understood. So we need to just to create the idea, put the idea into the paper.
Right, that's right.
Prof, one quick question. The endowment fund for the individual assignment, the endowment fund is a present value, isn't it, Prof?
Endowment fund is?
We just calculate the present value. I mean the desired income divided by the annual interest rate, isn't it?
No, you create the endowment fund must generate a certain amount of dividend every year, and that dividend, when you divide by 12, is equals to your pension, monthly pension that you want.
Okay. Okay, Prof. Thank you.
All right. Okay.
Thank you, bro.
All right. See you next Saturday.